Hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. Happy to have you back with us after what seems like a few weeks away. Last week you had your midterm exam, so I didn't get a chance to see you last week. The week before that, I was somewhere. I don't remember. Something was going on, but I appreciate all of you and your patience throughout the past 2 weeks as we worked through all of that. Glad to see the results from the midterm exam. It seems like most of you did very, very well, so I'm happy with all of that. On average, most students get A's, B's, and a few C's in this course because of how straightforward it is. And I'm glad that you all are enjoying that. And I just want to tell you how proud I am of all of you uh, because of your hard work that you've been doing throughout these past few weeks. You're all doing very well in the course. So just want to let you know that I'm happy and I'm very proud of you for your hard work and for everything you're doing. So let's do our best to finish this semester out strongly. Uh, we're currently in the week 5 already, if you can believe it. The time goes by so quickly. So in the classroom, module 3, week 5, we got today we're going to talk about budgeting, and we'll also talk about standard costs throughout these 2 chapters. And of course, this week you'll have your homework assignment and quiz that correspond with each chapter. Got a couple exercises in there as I normally do, just to kind of help you to understand the content a little bit more. Then next week we'll have week 6. We'll cover chapters 24, 25. The following week we'll do chapter 26 in week 7. And then a few days later you'll have the final exam. And then we'll be done. So we're less than a month away from finishing this course. So again, thank you all so much for your hard work so far. I'm really proud of all of you. And just keep up the great work, okay? Let's try to finish this thing strong. We only got a few weeks left, and I know we can get through it. So, okay, let's talk about budgeting. The concept of budgeting. The nice thing is with budgeting is you can apply some of these concepts to your daily lives as well, because a lot of these budgeting concepts in business we can apply to our monthly lives, if you will. Um, what I like to do with my personal budget is I sit down and I say every dollar has a place, and I say, okay, well, I know I have my rent due the first of every month, and it's a certain amount, and then okay, well, I have an idea that my electric is due every single month at the same time, and it's around a certain amount. Uh, and I sit down and okay, here's my monthly income, here's my monthly expenses, and I write it down. That's a budget. We do the same thing in business, and we budget every single line item on our income statement. As you remember, the income statement has your revenue, your income, and your expenses. Now, the way that we budget for revenue is through what we call a sales budget. We're going to talk about that. And we'll talk about how we budget for expenses and how we budget for the balance sheet items as well, like cash. There, it's really important that we create these budgets in business as we move forward, because we want to make sure that we have enough cash on hand to be able to pay our bills, of course, but also enough cash on hand to look at growing the business in the future, things like that. So I want you to kind of get into that mindset as we talk about budgeting and planning, and as we talk about cost controls and things like that. So I'll talk to you about the benefits of budgeting and why we do it, and I'll give you a lot of real life examples of things that I went through as a financial controller in budgeting, and kind of give you an idea of what it looks like in real life. Let's talk about the benefits of budgeting first. Why do we budget? Well, first reason why we budget in the first place is to plan for the future. We plan for our future opportunities. I need to know how much money I have available to spend in the future. And the way I do that is through budgeting. I budget for my sales, I budget for my expenses. And the company has some goals in mind. Okay. So I plan. But before I plan, one of the first things I do is I communicate. I talk to myself, I talk to my people in my organization, my business, and I say, okay, uh, we need to create a budget. The reason why we need to create a budget is because we got to figure out how we're going to hit our goals. So first, I communicate, then I go through what the coordination process. Okay, and what I do is I go to all of my department managers and I say, okay, give me a budget for your department for the year. I want to know how much you plan to spend in your department. I want to know how much you plan to get in sales for your department. So I involve other employees in the budgeting process. When you involve other people in your business, it makes them feel valued. Okay? It provides them with a sense of belonging. So it's really important that you engage other people in your business in the budgeting process because it allows them to give some input into the business. Budgeting helps me to coordinate the work across the business. If I have a budget for each department and I put them all together in what we call a master budget, I can see the progress that the entire business is making throughout the year. And the budget helps me to control the performance, to benchmark it. How are we doing compared to the budget? And throughout the process, I'm motivating my employees to attain the goals. For example, a company might set a goal to reduce our operating expenses by 10%. Well, how do I do that? Well, I look at the budget and I compare that to the actual performance. And I say, okay, I see that these particular line items on my income statement, I was over budget. Now, why did that happen? Now I look into why it happened, and then we figure out ways to reduce those expenses. That could be a goal for the business. Another goal for the business might be I want to increase my sales next year by 15%. That's a great goal. How do we do that? Well, let's look at the budget and areas where we can try to do a little bit better in terms of sales. So these are all great benefits to having a solid budget for your business. Budgeting is very human driven. Okay. Uh, I used to say this to my students that budgeting is 80% behavioral, 20% book knowledge. 80% behavioral, 20% book knowledge. Here's what I mean by this. Finance and accounting is driven by human behavior. Behavior causes people to act certain ways. Okay? The behavior, of course, is driven by motivation and other factors. But behavior drives budgets. Behavior drives accounting and finance and business. Now, let's talk about behavior. Human behavior is affected by, a lot of different things, a lot of different factors. I behave well because X, Y, and Z. I have I have personal and professional standards that I live by. Okay. I have certain guidelines that I follow. I have goals I want to attain, personally and professionally. This is why human behavior drives accounting and finance and business. Let's look at it from a budgeting perspective. A budget could be a positive motivator for you and your employees. Whereas your employees are impacted by the goals that you set. The goals could be challenging and attainable at the same time. Your employees might be evaluated based off of their performance on the budget compared to their actual performance. Like, for example, let's say you have salespeople and you gave them a goal of increasing sales by 10%, 15%, we'll say. And you have a budgeted sales amount of a 15% increase. And throughout the year, you're watching the sales come in. You can compare the actual sales to the budgeted sales amount. And so what that does is it creates an opportunity for you as a manager or a business owner to evaluate your employees' performance based on the budget. So all of those things kind of are the positive motivating factors for your employees. Here's the flip side of that coin. Sometimes people can be negatively influenced based off of their human behavior. Okay? Especially when it comes to budgeting. I'll give you a personal example of this. Sometimes you might have a good month. Oh, you got an extra paycheck that came into your pocket. Yeah, because some months you get paid 3 times instead of twice. Or let's say you worked extra hours. Okay, and so you got some overtime money coming in. Great things, love it. What does that do to you? Your behavior, right? You have a household budget. You have to pay the rent. You have to pay the utilities. You have to pay the insurance. You got to pay the food bill, etc. You know in your mind, you got a little extra cash coming in. So you might use that extra money for going out to eat. You might go buy yourself something nice. You should be saving that money, right? So sometimes having that little extra cash can be a negative behavioral outcome. That's a personal example. On a business example, if you, let's say, are budgeting your sales and you kind of budget the sales a little lower than you should, meaning I'm going to make this goal real attainable, real easy. Oh, I can easily increase my sales by 5%. I should be aiming for 15, but I'm going to aim for 5 because I know I can get 5. What that does is it kind of makes your employees a little, I don't want to say lazy, but if they can easily attain the goal, I mean, it's not really a goal then, is it? But you see my point. Give them too much of a cushion, it kind of gives them a little bit of leeway. So let's look at these negative potentials of budgeting. Employees might understate their sales and overstate their expenses to allow for a cushion. Sometimes in budgeting, you want a little bit of a cushion, right? Because your electric bill might come in higher than what you budgeted for because the cost of energy went up. say. Your gas bill might come in higher than what you budgeted for because the price of gas went up, right? That's why some cushion's good, but you don't want too much of it. For example, if your average gas bill, we'll say, your Washington gas bill, let's say your average Washington gas bill's $50 a month, okay? So you decide, you know what? I know it's $50 a month, but I'm gonna say it's gonna be $100 a month. What you're doing there is you're overstating your expenses. You're saying your gas bill is going to be $100 a month, but you know it's not going to be that high. That's too much of a cushion. The reason for that is because you could be allocating that part of the budget somewhere else. All right, so it's not a good thing to understate your sales or overstate your expenses because you don't want too much of a cushion. You want to try to come in close to where you actually normally are. If your sales are normally $80,000 a month, you want your sales budget to be around $80,000 a month. You don't want to say, oh, it'll be 100,000 or oh, it'll be 60. If it's normally something, try to budget around that number. The same with expenses. If your electric bill is normally $100 a month, your expense for utilities around $100 a month. Don't try to get too creative when it comes to budgeting. You want to try to follow the trends of what it has historically been. A couple negative things that might happen from budgeting is that your salespeople might be pressured to meet results that might lead to unethical or fraudulent behavior. Okay. Sometimes if you put too much pressure on people, they might be inclined to help themselves to some funds, or they might be inclined to kind of fudge a couple of numbers. So don't put too much pressure on your salespeople. Employees might purchase unnecessary items to ensure the budget is not reduced the next period. Oh, where are my government people at? Okay. Okay, so if you work for a government agency, or sometimes even a nonprofit, oftentimes what you see in governments is that they'll spend as much as you allow them to spend. The reason why they do that is because they want to make sure that they get the same budgeted amount next year. That's why you see ridiculous things in the news sometimes. My favorite ones is, oh, did you hear about the $100,000 toilet? Right. That was a real thing. So the government agency, I forget which one it was, spent $100,000 on a toilet. Now you think to yourself, well, that's ridiculous, because I could go to Home Depot right now and get one for like $80, right? Oh no. Well, the government needed to spend that budget so they can get the same amount next year. So they decided to overpay as much as possible for a lot of things. That's your tax dollars hard at work. So something to think about. But that's a negative behavior, right? Um, so these are just some behavioral things that are come along with budgeting to be aware of. When I budget, I look forward into the future, right? I'm budgeting for next month. I'm not budgeting for November. November's almost done. I'm not going to budget for November. I'm going to budget for December. Okay. Month of December, here's what my revenue is going to be. Here's what my expenses are going to be. In business, we don't just look 1 month forward. We look forward for a whole year. Okay. So a lot of you know me, and I used to be a financial controller, and when I was a financial controller, I was with a big hotel company called Radisson Hotels, and what we would do is I would get all of my department managers for the hotel together. Like put them in the conference room. I'll go down there with them. I'll tell them, hey, listen, we're going to do the budget. And when we do a budget, we do it for a whole year forward. So I'll get them together, usually around June, July, next year's budget. Okay, we do it real early. The reason why we do it early is because it takes a long time to process. So, hotel, we got a lot of different departments, right? We got the front of house, back of house. We have the rooms division, food and beverage division. We have a maintenance department. We have administrative departments. We have our sales department. Okay, so about 5 departments roughly. Some hotels have 7, some have 5. Just think about how a hotel is, right? You have your guest rooms, you have banquet space, you have a restaurant, you have a lobby, you have the back of the house, where all the maintenance is done. You have your housekeeping department, and you got your sales department. Okay, it's a lot of departments. Each department has to do their own budget. Department will tell me what they plan to spend money on for the year. So they budget it all out. And I tell them to do it for a whole year. The reason why we do it for a whole year is because I need to make sure that the month's performance is measurable. Okay. I take their actual performance from the previous year, compare it to the current year, which will help me to forecast for the next year. So each department does their budget for the whole year. Then they give the budgets to me. I compile them into what we call a master budget. I take that master budget and I spread it out across the year. Okay, here's my sales for each month. Here are going to be my expenses for each month for the whole year. And then as the months go by, so let's say end of January, at the end of January of 2023, I need to be budgeting for the February 2024. Here's what I mean. Right now we're in November 2022. November's already done in my mind. December 2022 is coming up in the next 2 weeks. I need to have, for my household, I have to have my budget completed for December 2023. That's 12 months out. That's a full year out. At the end of December, I need to have the budget for January 2024. And then at the end of that month, you see where we go. I'm sorry, I meant January. Yeah, January 23, February 2023, February 2023, March 2023, etc. As each month completes, you're completing 12 months out. 12 months. You constantly have 12 months worth of a budget to work with. We call that forward budgeting or rolling budget. So in the hotel business, like I said, we have a lot of different departments. We have the front of the house, back of the house. You got your food and beverage, sales, support offices, maintenance, etc. They all complete their budgets. Each department has their own budget. They complete their budgets for all of their revenue and expenses. We compile that all together in what we call a master budget. In a manufacturing business, like an automobile manufacturer, for example, we also have what's called a production budget. Now, here's how this master budgeting concept works. All budgeting starts with a sales budget. The sales budget tells me how many units I expect to sell during the year. How many units I expect to sell during the year, and at what price. How many dollars am I going to bring in, and how many units am I going to sell? That's what a sales budget consists of. So we always start with a sales budget. That's the number one thing you do is forecast your sales. You forecast your sales, you say, how many units do I expect to sell during the year, and at how much am I going to sell it for? Okay, that will give you sales dollars and number of units you expect to sell for the whole year. So first thing we do is sales budget. So if I'm an auto manufacturer, I ask my dealerships, how many units are you going to sell and at what prices throughout the year? They come back to me with that information. I create my sales budget. The sales budget drives a couple of different things. Based off of the amount that I expect to sell, I can create a few other budgets. I could create what's called a selling and administrative expenses budget, which are all of my expenses, right? I could also create a capital expenditures budget, which is the amount that I'm going to use to invest property, plant, and equipment. And I could create what's called the production budget. The dealerships told me how many units, how many cars they expect to sell throughout the year, and at how much. I take that information and I create what's called a production budget. They expect to sell 100,000 cars throughout the year. Great. They already have 10,000 cars on the lot. Great. That means I need to produce 90,000 cars this year. So I say in the production budget, based off of the sales information, I need to produce 90,000 cars for the year. With the production budget, I create 3 additional budgets. They all belong within the production budget. A direct materials budget, a direct labor budget, and a factory overhead budget. If I expect to produce 90,000 cars for the year, I need to make sure that I have enough material to produce the 90,000 cars, enough labor allocated number of hours to create 90,000 cars, and enough factory overhead applied to the 90,000 cars I expect to produce. Direct labor, direct materials, factory overhead, I budget for all 3 of those things within my production budget. Once I'm done with the production budget, I can budget for the amount of cash that I'm going to need to come in and go out in order to finance the operation of the business. Make sense? Everyone's clear on the concept of master budgeting, or at least the way it's designed. We're going to jump into each one of these budgets. I just want to make sure that you all understand the basic concept. Thank you, Tia. Okay, great. Remember, you can always unmute your mic if you have a question. So let me show you the master budgeting process. As I had said, all budgeting starts with a sales budget. The sales budget tells me how many units I expect to sell and at what price. Okay, so the sales budget tells me the number of units I expect to sell and the amount of money I expect to sell them at. Yeah, so sales dollars and units is what I'm going to see on my sales budget. This information, of course, can be affected by economic and market conditions and the capacity of the business and how they plan to advertise these units. For example, since we're in a car business, the economic and market conditions, interest rates, right? Market conditions, are cars popular right now? What's my business's ability to produce the 90,000 cars? Okay, we call it capacity. And advertising plans. How do I plan to advertise these new cars coming off the line? Those things affect my sales budget. Again, my sales budget tells me the number of units I expect to sell and the price per unit. Here's an example of a sales budget. This company right here, the one I'm about to show you, they create hockey sticks. You know, the sport hockey, right? There's a puck and it's on ice and you got two teams and they try to get it into a big net. They have what's called hockey sticks. It's what they use to hit the puck with. So this company makes hockey sticks. This is the example, yeah. Last month, month of September, they sold 700 hockey sticks at $60 each. It's not bad, right? So $700, $60 each in the month of September. So they use this information to help them to prepare a sales budget for the next 3 months, next quarter. Month of October, the company expects to sell 1,000 hockey sticks at $60 each. November, they expect to sell 800 hockey sticks, $60 each. December, 1,400 hockey sticks, $60 each. So what we do is we take the number of units and we multiply that by the sales price to give us the total budgeted sales dollars for the month. Okay. So October, 1,000 hockey sticks, $60 a piece, 60,000. Number of units times the sales price. That for October, I did that for November, I did that for December. I add the 3 months together to get the quarter budget for sales. So for the fourth quarter of the month, which is October, November, December, for the fourth quarter of the month, I expect to sell a total of 3,200 hockey sticks at $60 a piece, giving me a total budgeted sales dollars of $192,000. Ideally, in business, you want to do that for the whole year, not just for the next 3 months. Okay, you want to do it for the whole year. You go through the same process for the whole year. You know, every month you break it down. I expect to sell this number of units during the month times sales price. So now that I know how many units I expect to sell each month and the sales price and how much I'm going to bring in, I can create my production budget. So we prepare the production budget showing the number of units I need to make. So if I look back at my data, again, for the fourth quarter, I expect to sell 3,200 units. Okay, so 3,200 units I expect to sell. So how many do I need to make? Well, that depends. If I'm going to sell 3,200 units, I got to figure out how many I need to make. And I do that based off of the amount that I already have on hand. Okay, so I take my budgeted ending inventory units. This is the amount of units I expect to have at the end of the period, at the end of the 3 months. I want to have this many units on hand. So budgeted ending inventory units plus the budgeted sales units, 3,200. I know that number. Minus beginning finished goods inventory. This gives me the number of units I need to make. Yeah. The number of units I need to make, units to produce, is based off of my desired ending inventory plus number of units I expect to sell minus beginning finished goods inventory. So it shows, it gives me an idea, yeah? It gives me an idea of the number of units I need to make. So what does that look like based off of our sales figures that we expect? Okay, October, November, December, 3,200 units. Okay, month of October, 800 units is what I expect to sell. Based off of the 800 units, I expect that I would be able to go through 90%. Okay, the 90% comes from the idea that I'm going to sell through 90% of all my inventory each month. Okay. The company got that based off of historical data. That's where that number comes from. It's kind of made up, but not really. You know? It's a good estimate. Take 800 units that I expect to sell times 90%. It gives me 720 units. The 720 units is what I expect to end the month. I then add in the previous month's budgeted sales. In the month of September, which is not on this sheet, I expected to sell 1,000 units. So that means I would need to have 1,720 units available for production. Okay, I expected to have 1,720 units available for production. It's the required number of units. I subtract out my beginning inventory balance from last month, from September, which was 1,010 units. That means for the month of October, I need to manufacture 710 additional hockey sticks in order to meet my sales goal. So you see this 720. That amount is my desired ending inventory. I want to end the month with 720 units on hand. Obviously, the reason why you want to have inventory at the end of the month is because you want to roll that forward to the next month. So this is what this production budget looks like. Number of units we expect to sell times the sales ratio gives us the budgeting ending inventory. The ending inventory is our desired ending inventory, okay? So if it's ending inventory for October, that means it's beginning inventory for November, right? That's why you see that red line with the arrow. Plus 1,000 units I expected to sell equals my required units of available production minus my beginning inventory from the previous month equals the number of units I expect to produce. And I do that for every month. Now, that's the production budget. Okay, that's like the high level production budget. But as we talked about earlier, there are three budgets that come along with a production budget. Your direct materials budget, your labor budget, and your overhead budget. Remember, direct materials, direct labor, factory overhead, these are the things that create a product. These are the costs that create a product. And we need a budget for all three of those things in order to have an accurate production budget. The direct materials budget shows us the cost of the direct materials that we need to purchase in order to produce that 710 units for the month, right? So, and that's based off of our production budget. So based on the production budget, 710 units for October, I'm going to need to purchase some additional wood to build these hockey sticks with. Yeah? So I need to produce 710 of them. It takes half a pound of wood to build a single hockey stick. If I'm creating 710 hockey sticks, each of them requires half a pound of wood. That means I need a total of 355 pounds of wood to produce 710 hockey sticks. I already started the month with some wood, and I also want to end the month of October with some wood raw materials inventory. So what I do here is, once I know what I need in order to produce the 710 hockey sticks, I'm going to add in desired ending inventory. This example, 335 pounds of wood. That means I need 690 pounds of wood. Then I subtract my beginning inventory balance, what I started the month of October with, 178 pounds. That means I need to purchase 512 pounds of wood. In the month of October, a pound of wood would cost me $20 per pound. So to find the total cost of direct materials for the month of October, I take the number of the pounds of wood I need for October to purchase and multiply that by the purchase price. So 512 times $20 is $10,240 of total wood purchases for the month of October. Then I do the same thing for November and December. See the pattern, right? See the pattern. That's materials. Now for labor, we budget for labor. The way we budget for labor is we need to identify, based off the sales budget, or the production budget, sorry, based off the production budget, number of units I expect to produce for the month, times how long it takes me to produce a single unit. So, number of units I need to produce for the month. For October, 710. It takes me a quarter of 1 hour to produce a single hockey stick. 710 hockey sticks to build times a quarter, 0.25. Gives me total direct labor hours needed for the month, 177 and a half hours. What I need the month of October to create 710 hockey sticks. Once I have that information, I multiply the total direct labor hours needed for the month, 177 and a half. I multiply that by the hourly rate for labor. In this example, it's $12. So 177.5 times $12 per hour gives me $2,130 of total direct labor cost for the month of October. I do that same process for every month. It's the budgeted production in units times the amount of time it takes to create a single unit equals total direct labor hours needed times the hourly rate equals the total cost of direct labor for the month. That's how I get my direct labor budget. Very straightforward. Factory overhead. As you recall, factory overhead, that's all that other stuff that I cannot directly apply to a single unit. Remember? It's things like electricity, maintenance, supervisor salary, rent for the space, etc., etc. That's all overhead stuff. I need to be able to budget for it to apply it to the cost of manufacturing. And so it works very similar to direct labor. Of course, instead of the amount of time it takes to create a single hockey stick, we use what's called the single wide plant. The single plant rate wide single the plant rate wide method. Okay. It's the overhead rate, right? Remember when we talked about overhead, there was a couple of different ways to compute it. One of those was a single wide plant rate method. And what that did is it gave us an amount, right, per usually based off of an hour or based off of some factor. Sometimes it was based on labor, right? So we have a overhead rate for the factory. What we do is we take the number of units I expect to produce for the month and multiply that by the overhead rate. That equals the budgeted variable overhead. Remember what we learned about overhead. There's variable overhead and there's fixed overhead. Variable overhead is based off of the number of units of output. Examples of variable overhead are things like electricity, storage, things like that. They vary based off of the usage. Right? We have fixed overhead. Fixed overhead are things like supervisor salary, rent, things that do not change over time, right? That's fixed. Take the number of units I need to make times the overhead rate equals the variable overhead. I add in my fixed overhead. That equals my total overhead budget for the month. I do that for each month. Very straightforward. So now that I know my direct materials, my direct labor, my variable overhead, my fixed overhead, I can get a total production cost per unit. Here's how it works. Direct materials takes a half a pound of wood at $20 per pound per unit. Remember? That's $10. Direct labor. It takes a quarter of an hour to produce a single hockey stick at $12 per hour. 12 times a quarter, that's $3. The variable overhead is based on the overhead rate. The overhead rate was $2.50 per unit. Fixed overhead. Remember, the fixed overhead was a total amount. For the 3 months, October, November, December, you add those 3 months together, gives you $4,500 of total fixed overhead. I take my total fixed overhead, I divide that by the number of units to produce. 4,500 divided by the 3,000 units I need to make for the quarter gives me $1.50 fixed overhead per unit. I add all these things up. I add direct materials per unit, direct labor per unit, variable overhead per unit, fixed overhead per unit. Those 4 things together equal the total product cost per unit. This example, $17. Make sense? Still good. Budgeting gets so boring sometimes. All right. Forget. So we had our sales budget. That gave us our production budget. We were able to budget for direct materials, direct labor, factory overhead. From that information, I can create what's called a cost of goods sold budget. I know the number of units I expect to sell, okay, and at how much I expect to sell it at. And now I know how much each unit costs. I can get my cost of goods sold budget, right? So I take the number of units I expect to sell times the cost per unit, $17 in this example. That will equal my budgeted cost of goods sold. I can also budget for my selling and administrative expenses. Selling expenses are the type of expenses that are related to the sale of the products, right? Sales commissions, sales salaries. These are selling expenses, okay? Other expenses might include things like shipping, but it's related to the sale, right? Related to the sale. So commissions, salaries, sometimes shipping, things like that. These are sales expenses. In our example, we pay our salespeople a commission of 10% of total sales, and we pay our sales manager a salary of $2,000 a month. So I can budget out my sales expense based off of that information. If I expect to sell $60,000 worth of hockey sticks in the month of October, and I pay a 10% commission, that means I'm going to pay my salespeople $6,000 for the month of October based on that commission. I pay my sales manager the same amount each month, right? It's a manager, monthly salary, $2,000 in this example. This means I'll have total selling expenses of $8,000 for the month of October. It's my sales commissions plus my manager's salary. The sales commission is calculated by taking the budgeted sales times the commission percentage. In this example, 10%. I add up all 3 months to get my totals, of course. I mentioned administrative expenses. We call these general and administrative expenses. These are related to the sales and manufacturing process, but are not included. Remember, we used to call these period expenses. We have general administrative salaries. These are office people, $54,000 per year. And so we can prepare the budget for that. Very straightforward. It's $54,000 per year. Divide it by 12, you get $4,500 per month. Very, very easy. I can also budget for my capital expenditures. Remember, capital expenditures, that's what I want to do with my company moving forward. I want to invest in property, plant, and equipment. Okay? Purchase new machinery, purchase a new building, purchase whatever, yeah, to help the company grow. Those are capital expenditures. So I need a budget for those things. So in this example, I plan to acquire a new piece of machinery using cash for $25,000 worth in December. And so what I do is I budget for spending $25,000 in cash for December for capital expenditures. Now, how do I do that, right? I expect to spend $25,000 in December. I need to be able to budget for that expenditure. If I'm using cash, I need to prepare what's called a cash budget. You should be preparing a cash budget anyway. Cash budget can be a little bit complex, so I'm going to give you kind of the basics of a cash budget. We expect cash to come in from our customers, right? From sales and sales on account. Remember, sales on account is when I provided the good or the service to the customer, they have not yet paid me. That's called accounts receivable. I expect to collect that accounts receivable at some point after the sale has been made. So I expect to collect some percentage of my accounts receivable each month. That gives me an expectation of my cash inflows. It's sales from my cash customers and sales from accounts receivable. Those are my cash inflows. My cash outflows are when I have to pay my bills. I pay the electric bill, pay my employees, pay the rent, pay whatever's. Pay some loans, etc. That's cash going out. So cash coming into the business minus cash going out of the business, that's what we call net cash flow. I'm sure you remember that conversation when we talked about the statement of cash flows a long time ago. But let's take a look. We take the beginning cash balance, how much cash we have in the bank today, plus budgeted cash receipts. This is the cash I expect to collect from my customers from sales and from the collection of my accounts receivable. Minus cash payments, how much I expect to pay out throughout the accounting period for things like rent, utilities, expenses, normal day-to-day operating expenses, It will equal my preliminary cash balance. If my cash balance is too low, I should take out a short-term loan to cover the difference. If it's good enough or better than good enough, if I have more than enough cash on hand, I can look at things like repaying loans, buying securities like stocks and bonds, etc. This is the basic formula for it. In cash balance plus expected cash coming in from sales and accounts receivable minus cash going out for the day-to-day operations equals preliminary cash balance. If it's good or high, we can repay loans and do some investing. If it's too low, I need to take out a short-term loan to cover the difference. So my cash from sales. In our business, we collect 40% cash from our customer at the time of the sale. The other 60% comes from accounts receivable. So in order to budget, I need to look at my sales data, my expected sales data. Month of September, which is already passed, I made $42,000 in sales. And of that 42,000, 60% of my customers are on account, 25,200. Those customers pay me a month late. Time of the sale, they take the hockey stick home with them. They're going to pay me within 30 days. So they'll pay me in October. The month of October comes, before October comes along, I expect to sell $60,000 worth of hockey sticks. 60% of my customers are on accounts receivable, so that's 36,000. 60 times 60% is 36,000. They'll pay me in November. 24,000 I'm receiving in October from sales I made over the counter, or will make over the counter. Remember, 40% of my customers pay me at the time of the sale. And I'm going to collect from the previous month, September, 25,200, which tells me I'll collect a total of 49,200 in the month of October. That's my cash sales customers, 40% of total sales, plus the accounts receivable from the previous month. The same thing for November and December. This gives me an idea of my cash receipts for each month. Of course, throughout that each month, I'm going to need to pay for operating the business, buying materials, for example. So I use cash to buy additional materials for the manufacturing process. I need additional wood to create more hockey sticks, right? So what we do is we look at the balance sheet and start budgeting based off of the schedule of cash payments for the materials. I'm not going to buy all of the wood up front. Okay, I've usually spread it out. That's what most businesses do. Otherwise, you might get stuck with a whole lot of tied up in raw materials inventory. So I budget out where my cash outflows are going to be for the purchase of materials moving forward. The way we do that is we look at the cash coming in to understand when I need to make my purchases for materials. And that's what this shows us. If I purchase it in October, I can purchase it on account, so that means I won't pay until the following month, right? And of course, I need to pay for prior month's purchases in October. So I paid for September and October. I'm going to pay in November. I'm going to pay for October's purchases, so forth and so on. So the quick and easy formula for preparing a cash budget, it's the beginning cash balance plus the cash I expect to collect from my customers minus the payments I expect to make for purchase of materials, etc., equals the preliminary cash balance. If it's good, I can repay loans and do other things. If it's not so good, I might need to take out a short-term loan. This is the process for the cash budget. This is what it looks like. The cash budget looks like on paper, if you will. So beginning cash balance plus receipts from my customers minus cash going out for materials, labor, overhead, etc., 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 all my expenses. gives me total cash payments, and that's the cash payments. So my cash coming in minus my cash going out gives me my preliminary cash balance. If it's good, great. If it's not good, take out a loan. That's what it shows us. Cash coming in, then take out your expenses. You see, like everything's mapped out. And that's the whole idea behind budgeting. Smokes, we'll get there someday. Yeah, right. So once you've established your cash budget, you can budget for your income statement, which is all of your different expenses. And that's a great idea. It's a good thing to do. You could budget for all of your various expenses. Once you've budgeted all your expenses out, you can also budget for your taxes, right? Because we all have to pay income tax. You could budget your balance sheet as well. As you know, your balance sheet shows your assets, liabilities, and equity accounts, and you can budget for all of those based off of your cash budget. Yeah, what I just showed you is the entire budgeting process. You can budget for service companies as well. As you recall, service companies do not have direct materials. They do not have overhead, but they do have labor. So you can budget for your sales for your service companies, like your attorneys or your accountants or whatever, your lawn service companies. They budget sales, they budget for direct labor, they produce a cash budget, same exact way that we do in a manufacturing business. You can also budget based off of activities. So activities, as you know, through activity-based costing, remember that concept we learned some time ago. When you budget based off of activities rather than traditional amounts, you get different budgets for each line item. But it's really the same process. For a merchandising company, like a retailer, like Macy's, for example, they go through a similar process. They start with a sales budget. They go to what they call purchases budget. Remember, a retailer, they purchase their inventory from vendors, right, or distributors. So that's what we call the purchases budget. And then they can budget for their cash, selling administrative expenses, and capital expenditures. Again, they follow the same process. Really, every business follows the same exact process. So this example is for a retailer. To find out how much inventory they need to purchase, they take their ending inventory plus budgeted sales minus the beginning inventory equals inventory they need to purchase. Very straightforward formula. And then they can also create their own sales budget for a retailer. But it's again the same exact process that we used in manufacturing. The only difference, of course, is they don't prepare a production budget. Any comments, questions, or concerns on budgeting so far? We're doing okay?
Yes, sir, I'm following.
Okay. I know it gets boring sometimes. Okay, let's do this. Let's take a 5 minute break, shall we? Actually, let's call it a 7 minute break. Let's meet back here at 12:20. Take a break.